Hello, everyone. Today on the Final Bar, we will wrap the week. We'll look at how the market has evolved in the last 5 trading days, focus on the S&P coming off a bit here going into the close on Friday, closing around 46.76. Overall, the market did okay, or the market was down, or the market was flat, depending on what you define as the market. We'll look into that a little bit, look at some of the cyclical sectors that held up pretty well, with energy up today and finishing the week up 10%. Ladies and gentlemen, this is the Final Bar. Hey, everyone. Welcome to this Friday edition of the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a very rainy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the market environment using the power of StockCharts, using the technical analysis toolkit to better quantify investor behavior, using the indications embedded in price and breadth and sentiment and momentum and all the other good things that we talk about on the show. The overall, this market weaker this week and starting 2022 in a position of weakness coming off of the strength that you saw into year end at the end of December. However, certain sectors are doing just fine. If you look at financials and energy stocks, they're up today. Utilities were up today. The weakness that you see in the major averages is really, I would argue, less about the fact that stocks overall are going down, but it's which stocks are going down. And when mega cap growth stocks are struggling, when growthy sectors like technology and consumer discretionary are underwater, it's hard for the S&P and certainly the NASDAQ to be in the positive when that's the overall environment. So you're seeing rates continue high. You're seeing the 10-year make a new high for the last couple of years here today. We'll dig into all of those charts and more here as we wrap the week and focus on the key themes that you should identify as you wrap up this week and prepare for next week. We have such great guests on this show. I was really enjoyed some of our conversations this week with some fantastic, very thoughtful and knowledgeable guests. Next week, more of the same. On Tuesday, the 11th, we have Bill Baruch from Blue Line Futures joining us on the show for the first time. On Wednesday, the 12th, Dana Lyons from the Lion Share Report. On Thursday, the 13th, Mary Ellen McGonigal from MEM Investment Edge. And then next week after that, on Tuesday, the 18th, Andrew Thrasher from Thrasher Analytics. Some really talented analysts and money managers joining us on the show here. We also have a lot of special content here. January is a busy month on StockCharts TV, trying to help you prepare for this uncertain year and uncertain times. Larry Williams just recorded his market outlook special that'll be airing today, actually, on the 7th. Might be tomorrow, actually, but coming up very soon if it's not out already. We have Bruce Frazier sitting down with Martin Pring. That's going to come out next week on StockCharts TV. Martin Pring, obviously one of the best in terms of market cycles and economic versus business cycles versus stock market behavior. So don't miss that one. Also, we have our special Charting Forward 2022, our market outlook event featuring Gina Martin Adams from Bloomberg, Tony Dwyer from Canaccord Genuity, John Markman from Markman Insights, and many more special events coming up next week that should be airing on January 18th. Also, the next appearance of the Money Show Virtual Expos. I will be appearing next week at the Money Show Virtual Expo, the first one of 2022. I will be giving a presentation called 7 Questions to Ask Before Every Trade. We talk a lot on the show about having good routines, having a checklist, a disciplined way of making your investment decisions. I will share with you my technical analysis checklist, talk through some examples applying the 7 questions I think you should ask before you pull the trigger on any position, on any chart. Go to stockcharts.com/moneyshow to sign up for that particular event. All the other market outlook stuff that I mentioned earlier, just go to stockchartstv.com, our on-demand platform, to check all of those special events out. Let's continue on today's show. Friday's show is a little different than our normal daily show because we have 2 main segments. We'll do a market wrap, sort of a wrap the week segment, and then we'll go on after the break to answer your questions from the Final Bar mailbag. Wanted to start our weekly wrap with a poll question. We have a poll running on our live stream page on StockCharts.com, also on our social media accounts, so make sure you follow us there. And we asked you recently, which of these ETFs do you think performs best over the next 3 months? And I gave you 3 choices: US stocks, global developed markets, or EFA, using $EFA, that's the EFA ETF, or global emerging markets using $EEM, that's the emerging markets ETF. 74% of you, 3 and 4, said the S&P 500, stay with the US. Only 15% of you, 16% said EFA. Only 10% said emerging markets. And if I had to pick one of these, I would probably go US as well. And I think that's less about the weakness in international markets, although certain exchanges like China and others obviously feeling struggling quite a bit, but others like India are actually doing quite well on a relative basis. I think it's more about the dollar environment, and that stronger dollar that we saw through much of 2021. If that continues in 2022, which so far it appears like it is seeming to do, I think it's hard to justify going outside the US as a US-based investor. If that's where you're domiciled, if that's where you're parking your assets and it's in US dollars, the stronger dollar environment certainly suggests US over non-US for now. But the dollar chart would be the one I would watch to see if and when that's going to change. To wrap the week, we do a couple of different things. Let's talk briefly about what the market did today. We'll go quickly through our wrap the week chart, where we focus on the major asset classes and how they've evolved over the last 5 trading days. We'll finish with the Mindful Investor live chart list, which is a list of charts that I keep updated on StockCharts.com. So let's start with what happened today. The S&P off today, closing around 4677. That's 0.4% lower than yesterday. The NASDAQ, though, down about 1% using the NASDAQ composite, just below 15,000. S&P mid-cap and small-cap indexes both down as well, which is a little unusual given the strength that you saw in some of the cyclical sectors, but that's how things sort of played out. And the VIX is back below 20, continuing lower, just below 19 today. Other asset classes very quickly. Interest rates continue to push higher with the 10-year yield approaching 180. It settled in for the end of the day around 177, which is a high mark for the year. But that's not that impressive, but it's above the highs that we set in 2021. We'll look at that chart here in a little bit. Dollar index actually down today about 0.5%, with the UUP down around 24.65. Other asset classes continuing on. Gold and silver actually higher. And one of the interesting phenomena that we've seen is that even though when the markets have struggled, you really haven't seen gold and precious metals as much of a safe haven as you might have imagined. You're seeing that a bit today with stocks off and gold and silver moving higher. Commodities as a whole moving higher as well. And energy stocks, as I mentioned, doing just fine. A lot of red on the charts of cryptocurrencies. We talked about Bitcoin earlier in this week. We'll try to get there later today. Ethereum really the weakest of the bunch. And I think that was the case earlier this week as well. Ether down to around 3220, and this is coming off of 4,000 plus that we saw not too long ago. Bitcoin settling in right around 42,000 here as we record this after the close on Friday. And again, that's coming off of fairly elevated levels. Getting below 44,000 on Bitcoin puts you in sort of a no man's land, down to 40,000, which has been a big round number that has been fairly important for Bitcoin a number of times in the last 12 months. And I would certainly focus there and see if that key level of support is able to hold. Having said all of that, let's look at the, actually really quickly on the sectors. I think one of the key themes I wanted to hit on was on this on the sector summary page. So on your dashboard, I'd encourage you to put the sector summary on here because it's a great way to just recognize leadership themes during the trading day. Look at what happened. The S&P was down. Technology lower, consumer discretionary lower, and that was the worst of the 11 S&P sectors. But 3 of the S&P sectors actually finished firmly in the green. Energy up 1.4%, financials up 1.2%, utilities up 0.7%. So this is a mix in terms of what worked today. People are actually rotating into cyclical sectors like energy, interest rate plays like financials, sort of benefiting from rates going higher, and utilities, which is fairly clear defensive sector. Usually don't own utilities unless you need the income or you're just trying to ride out in a low volatility space. But for whatever reason, that sector was positive. So it's very much a value over growth feel to the market today. Let's look at the wrap the week chart, which is here. So this is looking at some of the major asset class ETFs and how they evolved from last Friday's close to where we're at now. And I don't have these labeled, so if you follow my voice and the mouse, you'll see what's what. The black line here sort of in the middle is the S&P 500, down 1.9% from last Friday. So that's on the end of last year to where we're at. So this is the year-to-date chart as well. And you can see that that stocks in the form of the S&P 500 down 1.9%. Gold, exactly the same or almost identical to that. Lower yesterday, but sort of bounced up today. Weaker stocks, higher gold, and they ended up netting out about around the same time. A number of things underperformed the S&P this week. Small caps were actually down 2.9%. That's using the Russell 2000 ETF. In this reddish color is bond prices using the TLT, which is a long bond ETF, down 4%. In pink, we have the NASDAQ 100, the Qs down 4.5%. Everything else on this chart outperformed the S&P. A couple of these were flat for the week. In orange, we have emerging markets. In green, we have the dollar ETF, the UUP. Both of those just above the zero line, up 0.1%. The big winner this week, crude oil prices up 4.25%. As I mentioned, energy stocks did fairly well over the course of the week, actually finished the week up 10% plus, over probably about 10.5%. I didn't see the move right into the close, but pretty decent week as the S&P is down almost 2%. You have one of the sectors up over 10%. So it shows you how some individual sectors and groups can have vastly different experiences than the overall market. So be careful what you call the market, right? Because it depends on what actually is in that index that you're looking at. If we have Bitcoin in the mix, that's the blue line here, was the weakest of all of them, down over 9% this week. And while the severity of the move this week might have surprised you if you're a Bitcoin bull and you're looking for some sort of stability, I would say the direction that you've seen with Bitcoin and with Ether should not be too much of a surprise. Overall, those are charts very much in distribution mode, failing to hold support, breaking down through moving averages. Those are the types of charts. Again, if you buy into the general approach to momentum investing, downtrends will stay downtrends until some sort of catalyst reverses. And what you're not seeing is buying power come in and alleviate the negative movements driven by selling pressure, driven from more supply than demand, or less demand than supply. Let's continue on and look at the Mindful Investor live chart list. And if you've never followed this before, easy to access this. If you go to the main StockCharts articles page, this is where all of our contributed content resides. You will see my homepage called the Mindful Investor. If you click on that, you will see a gray button at the top that gets you to this list of charts. I keep these updated during the week, but really at the end of the day on Fridays when I make sure they're all up to date, nice and ready to go for the show. And so you can access this set of charts, share them, send them, do whatever you like to them, even save them to your own account and make some changes to them. We will start with the market trend model. So this is basically looking at the market on 3 timeframes: long term, which I think of as a couple years or so; medium term, which is a couple months to a couple years; and short term, which is a couple days to a couple weeks. That's a general assumption I'm making about the different timeframes. And this is what these trend following techniques are designed to tell you about. As you look there, you can see when the lines are above zero, that is a bullish reading. If it's below zero, it's a bearish reading. It's very much a binary signal. It's either bullish or bearish. And I didn't put a neutral rating in when I sort of developed this approach to trend following. I just want to understand very quickly the 3 different time frames and represent with a systematic tool what I was trying to do visually, looking at a bunch of charts every week. So the long-term model has been very, very positive. The medium-term model has been very, very positive. As we're doing this, I have to note that the short-term model has indeed turned negative. The short-term model is very simply looking at where we're at relative to the 5-week EMA, the 5-week exponential moving average. And when it switches from above to below, which it did at the close here, I have to change it to a bearish reading, which is why I've just, as you're watching, I've changed this from a bullish reading to a bearish reading, just narrowly getting below the zero level. So long-term positive, medium-term positive, short-term negative as of today. And that's about what the market feels like given the distribution today. Now the S&P, and I'm not kidding, closed almost to the penny right to the 50-day moving average. That was the low of the day yesterday, right at the 50-day. We've now closed there today. We traded below there a little bit earlier today, but popped back up and now settling in right at the 50-day moving average. That is interesting to me because we've hit the 50-day moving average probably 10 to 12 times over the last 12 months. All but one of those times, the market has reverted right back to the upside and made new swing highs not too long after. So if 2022 is going to start being anything like 2021, you'd expect a buyable bounce right about here going into next week. It's very interesting to me that we're heading right into earnings season, which could certainly provide enough catalyst for the market to bounce higher from here. However, I think this is a really important level that we've reached. We've gone below 4,700, which is a key level of support. The next level, if we do fail here, and if we fail to hold the 50-day next week, is 4,550, which is the level of support we hit in December. We tested that a number of times and bounced higher, and that was a level that had been resistance back there in early September. I put a video out on my YouTube channel just this week talking about the concept of polarity, which is where resistance becomes support. So we don't have time to dig into it here, but if you go to my YouTube channel called Market Misbehavior, my latest video deals with that particular level and why 4,550 is so important. But it's a key level to watch. First things first, though, let's see if the 50-day is able to hold next week. Do we get that buyable bounce that we saw a lot of in 2021? Breadth, I would describe overall as sort of mixed. If you look at the cumulative advanced decline lines, the large cap and mid caps have both made new highs in the last week, new all-time highs, that is. The small cap and the New York Stock Exchange not yet above their November high and even not above their June 2021 high. So I would describe this as mixed. It's sort of positive on the large cap, but mixed on the small and sort of broader universe of the New York Stock Exchange. So I wouldn't say that those are overall supportive of this market. I would say at this point, it's a little more questionable. The last one, and then we have to wrap and take a break here, is looking at the relative performance of consumer discretionary versus consumer staples. I think of this as an offense versus defense chart. Are investors rotating more into things you want versus things you need? You rotate into things you need when you're getting defensive, and that is what the market has done over the last 6 weeks. Look at the equal weighted version of that ratio at the bottom. You can see since mid-November, this ratio has been going lower, which means investors are rotating out of consumer discretionary, out of offense, and into the relative defense of consumer staples. Let's take a quick break. We'll be back answering your questions from the Final Bar mailbag. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. So thankful that we're able to do the show every weekday and appreciate you joining us. We're going to do the mailbag segment here in a few moments. And just want to remind you, those questions all come from viewers like you sending in questions as you are running into issues, trying to analyze the markets using the technical toolkit. Questions about technical indicators, about StockCharts.com, whatever it is, we'll be happy to answer your questions on the air. Our email is the best way to get your questions to us, thefinalbar@StockCharts.com. We're on Twitter @FinalBarSCTV. We're on YouTube. Put a comment below the show you're watching on our YouTube channel. We'll gather all those questions. Hope to answer one of yours in our next mailbag segment, which will be Tuesday of next week. Also, go to StockChartsTV.com. That's our on-demand platform. All this great content, our show with all of our great guest appearances, and it can be really helpful to see what some of these guests were saying months ago, a year ago. What were people talking about? What was top of mind? And what has played out after that? It can be really, really valuable as a way to better understand market dynamics. Also, all of our year-end specials from December, our market outlook specials this week and next week, all of that at StockChartsTV.com or just on your mobile device, search on any of the app stores for StockCharts TV on demand. Our next segment is the Final Bar mailbag. I so enjoy hearing from all of you. I appreciate you sending your questions in. As always, it's really helpful if you include a screenshot of the chart you're asking about, if that's what you're looking at, or a link. If you do the permalink below one of the charts on StockCharts.com or on ACP, we can look exactly at the chart you're looking at. And let's get to it. This first question is on options. Give me a second here. I notice an intense full court press on almost every investment site that I visit and YouTube video I watch, trying to attract me to options trading. I think there's at least 2 ads for options in every 30-minute StockCharts YouTube video I watch. I don't hear you talking much about them on the Final Bar. What is your take on why options are being pushed so hard? As a novice investor, when should I take interest in these? Really, really good question. We certainly can't control what ads are showing on our YouTube channel. At times, I wish we could, but overall, they seem okay when I've checked them out. But you're right. I actually don't. And I think that That's great. I think our goal with StockCharts TV is to present a lot of different approaches, obviously technically oriented, because our goal is to empower people to make better decisions about their investment portfolios using the best practices of technical analysis and of charting and of behavioral finance. And that's what I really try to portray. I don't really get into options because that's not my background. When I worked at a large investment firm, we literally used almost zero equity derivatives. It was all plain vanilla stock picking. And so that's my background, and that's where I tend to gravitate to. You will find some of our guests are very options oriented, and we try to do a good job of bringing in some options experts, guys like Tony Zhang from Options Play. I'm trying to think of who else we've had a number of great guests that have been options, from Joe Duarte and the Money Options.com, and others that really Sean McLaughlin from All Star Charts comes to mind. So we are trying to do better, actually having more options oriented content on our channel. I can't tell you too much about shows that we're planning that are still in the early stages, but we will be having hopefully some options focused shows on StockCharts TV in the relatively near future. Also more options data on our platform and so forth. So a lot more to come on that. And I think why are options being pushed so hard? Because to be honest with you, for a lot of individual investors, they provide a lot of good opportunities. It provides opportunity for leverage, so you can get your capital to do more for you than you would otherwise. Also provides a lot of good downside protection. So things like covered calls and puts and certain strategies can help cushion you from market volatility. And so for a lot of individual investors, options provide a lot of the levers that institutions are able to pull because they're running so many assets. They have so much access to really cool, complicated strategies like interest rate derivatives that allow them to do pretty much anything. For individuals, you've not been able to have access to that sort of flexibility. Options really level the playing field in a lot of ways. So that's why I think they're helpful. I've always encouraged people to start looking at things like covered calls and more defensive option strategies because they line up very well with traditional analysis of stocks and ETFs, but there's a lot more on that. So we will continue to do our best to bring on options guests. And again, some option specific programming is on its way later in the year. Next question. When I look at $NYAD cumulative on daily and hourly charts, the daily shows a big drop in November and December compared to other previous months, while hourly does not show that big drop. How is that possible? It's a really good question. I'm going to see how quickly I can actually bring this up here. So let's say $NYAD. It's actually not the advanced decline index I usually use, but I bet we could make it work. So here we do this. And if we change it to a cumulative chart, there we go. So this is the advanced decline line using the $NYAD. Now, what you're asking about is how come the daily movement of the daily chart looks different than the movement of the hourly chart? And you can ask the same thing about like a weekly advanced decline reading as well. So here's the thing. What this is actually doing is it is saying, all right, this trading day today on January 7th just finished. How many stocks closed up? How many stocks closed down? This index is tracking the difference between net advancers or the net of advancers minus decliners. And then the cumulative thing basically just adds it. It's a running total of how that daily thing is changing. So if instead of just doing the daily close, you're actually treating the trading day as like 8 or 9 different closes, and at the end of every hour, you're looking at how many stocks closed up or down for that 1 hour of trading, all of a sudden the cumulative reading could look dramatically different. And the way I would say it is this: let's say the market actually has 6 hours of going up, and then the last 30 minutes it drops very, very quickly. The hourly advanced decline reading would probably be net positive because for most of the trading day, it was higher and higher and higher and higher. And the fact that a bunch of stocks closed down at the end of the last hour of trading probably wouldn't move the needle too much. But if you're just looking at a daily advanced decline reading, if everything sold off at the end of the day and got below zero, all of a sudden you have way more decliners at advancers, and the NYSE end of day advancers decliners would show a big net negative. So it's all about the calculation of those indexes. And if you're looking at a cumulative advanced decline reading, or even just a regular advanced decline reading for one full trading day or 1 hour or 1 week, the values could be very, very different. And I would just remind you that the time frame that you're trying to operate on should dictate which of those you pay attention to. For most investors, the daily advanced decliners tends to make more sense. I would say an hourly reading on that is only going to be helpful if you're day trading and really trying to capture some short-term dynamics. That's what I would suggest. That was a long-winded answer, and I hope that made sense to all of you. Final question probably for today. In stock charts, when do you find it best or most useful to chart international ETFs with dividends removed? So putting the underscore in front of a ticker. And you mentioned like EWG, which is Germany. So if I do EWG, this is the Germany ETF. If I do underscore EWG, this is actually removing the dividend impact. So, any sort of ETF or stock, most of them or many of them pay a dividend, a quarterly or monthly or semi-annual or whatever dividend it is. And what happens when you're charting a stock is you can either adjust the historical data for that dividend. So every time a stock pays a dividend, the price of the stock actually comes down, and that difference is paid out as a cash dividend to the investors or a stock dividend or whatever it is. And so that devalues in just a little bit the movement of the value of the price. And so if you unadjust the data, you see little gaps, and those gaps once a month or once a quarter are just purely the fact that it paid a dividend and you adjust it. What we do normally is we adjust the data series, which is a common practice to smooth out the data and basically say, I only want to chart the behavior, the buying and selling pressure, the relationship, the interaction between buyers and sellers. And by stripping out the impact of those adjustments of the dividends, you're actually getting a better, pure view of investor behavior. So when should you look at one or the other? I would say if you're trying to answer the question of what has my return been owning Germany versus owning the US, you want to keep the data adjusted, which means you don't put an underscore, you just do EWG, compare that to the SPY, and you'll get a good relative sense of what you own, what you gained as an investor owning EWG versus the SPY, because it's adjusting that. It's basically more on a total return basis if you look at the relative performance of those two tickers. If you are trying to identify particular support and resistance levels, particularly on something that has a healthy dividend, by taking the dividend adjustments or taking the dividend adjustments out of there and looking at unadjusted data, you actually have a better, more pure view of what the price has actually done. You're looking at where the thing actually traded at a certain point in time. That is what you should pay attention to if you're looking more at support and resistance levels. So the reason why there's not a great answer of when you should do one or the other, because it really is the question you should be asking is it's all about what question you're trying to answer with the data. And there's no particular best practice. I think there's an argument to be made for both unadjusted and adjusted data. I tend to use them back and forth because it depends on what I'm trying to accomplish. I would say longer term, as a longer term investor looking at relative performance, always adjust the data because that's what your experience has been owning that particular asset. That's all the time we have for the mailbag. Listen, thank you guys so much. Keep the questions coming. We'll do it again on Tuesday of next week, but we need to wrap to today's show and wrap the week with the 3 and 3 charts in 3 minutes. Here we go. We are going outside of the equity space and starting in crypto land. We're looking at Ether here. And if you look at $ETHUSD, which is Ethereum to US dollar, we can see that Ether has broken its 200-day moving average. Today, it's gotten down to 3,200, which is pretty significant. This is after bouncing off of a 38.2% retracement from the July low to the November high. If you take 38.2%, that's around 3,700. We bounced off of there a number of times in December. We've now broken that and also broken the 200-day, which means the next level of support is around 2,900, 2,950. Below there, boy, you're looking really far down to further support levels. Ether is actually oversold right now with an RSI below 30, which is an important thing to watch. A lot of growth stocks, by the way, also oversold. And that might be an interesting pattern to pay attention to. Second chart we'll look at is the performance of a couple different things. In black at the bottom is the S&P 500 down 1.9% for the week. In green, this is the XLF, the financial sector, which actually finished the week up 5.4%. Energy stocks finished the week up 10.5%. So when people tell me, what do you do now that the market's down? I will tell you the market was actually up. It depends on what you're looking at. The fact that the S&P is down, I think, is less to do with stocks as a whole doing poorly. It has to do with the weighting and the construction in those benchmarks, which are very growth oriented. Be prepared for the S&P to struggle at times, and certainly the NASDAQ, if value oriented sectors are working more than growth. Finally, looking at offense versus defense, we mentioned earlier, and we're looking at the Mindful Investor live chart list, the ratio of offense versus defense in consumer, the XLY versus the XOP, and the equal weighted version at the bottom. Look at how that ratio has turned lower in the last 6 weeks. That is telling you investors are getting more defensive, and in general, that ratio going down does not tend to bode well for the market as a whole. Folks, that is our show and a wrap for this week on the Final Bar. Thanks so much for joining us, and keep your questions coming. the final bar at StockCharts.com. Have a fantastic weekend from everyone at StockCharts. I'm Dave Keller. Be well, stay safe. We'll see you next week.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.